start by understanding what shareholders' equity really means. In the world of business and finance, shareholders' equity is a fundamental concept that represents the value of a company that is attributable to its owners or shareholders. It's often called the owner's equity or net assets. Essentially, it's what remains after a company subtracts its total liabilities from its total assets. This figure is crucial because it shows the net worth of a company from the perspective of its shareholders. Throughout this video, we'll break down what makes up shareholders' equity, why it matters, and how it's calculated. Fully grasp shareholders' equity, we first need to understand assets and liabilities. Assets are everything a company owns, like cash, inventory, buildings, and equipment. Liabilities, on the other hand, are what the company owes, such as loans, accounts payable, and other debts. The relationship between these two is key. Shareholders' equity is calculated by subtracting total liabilities from total assets. This simple equation forms the backbone of a company's balance sheet and helps investors see the true value that belongs to shareholders. Shareholders' equity is a major component of a company's balance sheet. The balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It lists assets, liabilities, and shareholders' equity, showing how these elements are interconnected. By reviewing the balance sheet, investors and analysts can quickly determine the net value of a company and assess its financial health. Shareholders' equity is usually found at the bottom of the balance sheet, highlighting its role as the residual interest after debts are paid. Shareholders' equity is made up of several important components. The main parts include common stock, preferred stock, additional paid-in capital, retained earnings, and sometimes treasury stock. Common and preferred stock represent the initial investment by shareholders. Additional paid-in capital is the extra money investors pay above the stock's par value. Retained earnings are the profits a company keeps instead of paying out as dividends. Treasury stock is any shares the company has bought back. Together, these elements form the total shareholders' equity. Shareholders' equity isn't a static number. It changes as the company operates. When a company earns profits and retains them, equity increases. If the company pays dividends or buys back shares, equity decreases. Issuing new shares can also boost equity, while losses or large payouts reduce it. These changes are tracked over time and reflected in the company's financial statements. Understanding how and why equity changes helps investors gauge a company's growth and management decision. Shareholders' equity is important for several reasons. For investors, it shows the value they own in the company. It's also a measure of financial stability. Companies with strong equity are generally better positioned to handle losses or invest in new opportunities. Lenders and analysts look at equity to assess risk and creditworthiness. In short, shareholders' equity is a key indicator of a company's financial strength and long-term prospect. Calculating shareholders' equity is straightforward. You simply subtract total liabilities from total assets. For example, if a company has $1 million in assets and $600,000 in liabilities, its shareholders' equity is $400,000. This calculation is performed regularly and reported in financial statements. It's a quick way to see how much value is left for shareholders after all debts are settled. This simple formula is at the heart of understanding a company's worth. There are some common misconceptions about shareholders' equity. Some people think it represents the cash available to shareholders, but it's actually the net value of the company. Others believe a high equity always means a healthy company, but it's important to look at the quality of assets and liabilities too. Shareholders' equity is just one piece of the financial puzzle, and it should be considered alongside other metrics for a complete picture. To wrap up, shareholders' equity is a vital measure of a company's net worth from the owner's perspective. It's calculated as total assets minus total liabilities and is made up of several components like stock, paid-in capital, and retained earnings. While it's a key indicator of financial health, it should be analyzed in context with other financial data. Understanding shareholders' equity helps investors, analysts, and business owners make informed decisions about a company's value and future.